Good afternoon, everyone, and welcome to this analysis of Bill Gates' stock portfolio. Or should I say more clearly, this is the portfolio of the Bill and Melinda Gates Foundation. So this is worth about 17 billion as of the last time the figures were released regarding transactions. And that's about 20% of Bill Gates' personal net worth. So let's get into it. We all know who Bill Gates is. Microsoft founder, philanthropist, investor, Warren Buffett's best friend. And as you'll see, this portfolio has a lot of Buffett influence on it. So if you're wondering how I got these figures, very good website called gurufocus.com releases them, because these are all publicly disclosed. You know, the Bill and Melinda Gates Foundation is a registered non-profit, and obviously they must disclose their holdings to maintain their status as a non-profit, so they have to disclose them. And websites like Guru Focus, they have pretty much all of the richest people, and especially the richest investors on earth, they have up-to-date notice of their portfolios. So as you can see on the screen right here, we have Gates' portfolio as of the last time the figures were released, which was at the end of June, and I'm recording this video at the end of August. So this is a couple of months old, so there may have been some transactions since then that we don't know about, but we will find about those soon. The biggest thing to note is that in the past quarter, they sold around 10% of their holdings in Berkshire Hathaway, and that came as a sale of B-class shares. So I believe they sold 5 million B-class shares, which is about a let me work this out, based on around the Berkshire Hathaway Class B was trading around $200 in the last quarter, so $5,200,000, that's 10 billion was sold, and some of that money was plugged into Apple, Amazon, Alibaba, Google, and I'm missing one. Oh yes, Twitter, which was cut off the bottom of this picture. But that's where the money went. And yes, the other one, Schrödinger Inc., which Gates owns 11% of. That is a company that just IPO'd this year, and Gates is a minority owner of. But as you can see here, some interesting names, some ones you'll be familiar with, especially if you've followed our work for any length of time. There's 4 names on here that made it to our 20 for 20 list of companies to buy and hold for the next 20 years. So that's Walmart, we've got Coca-Cola in there, we've got Amazon, and the other one, Crown Castle International, the cell tower REIT, which I was actually surprised to see in Gates' portfolio, but I was happy to see because, you know, it just confirms my own hypothesis about the future of that company. So let's get into it. Obviously we'll start with Berkshire Hathaway, which makes up 40% of Gates' portfolio. Now, you may think that's quite a lot to hold in one company, but Berkshire Hathaway itself is incredibly diversified. I've got on the screen here, you can think about it in 5 parts. You have the insurance business, which is, you know, the core business of Berkshire Hathaway. You know, it owns Geico, General Re, the actual Berkshire reinsurance business. The non-insurance business that it completely owns, so famous ones like See's Candies, NetJets, Dairy Queen, Burlington Northern Santa Fe, which they bought about 5-6 years ago now, Fruit of the Loom. So the non-insurance subsidiaries that Berkshire completely owns. And then businesses it has a stake in, Kraft Heinz, so consumer goods, Pilot Flying J, which is a chain of gas stations, and then it stakes in, you know, Apple, Bank of America, Coca-Cola, Wells Fargo. In addition to the cash position, which sits at 137 billion, That was at the end of 2020's first quarter. I believe it's a little bit down now because they made some acquisitions lately. You will have probably seen, it was very, very big in the news earlier this year. They sold all of their airline stakes at a big loss, and Buffett admitted himself that it was a mistake to buy them in the first place, which was an interesting move because he was very against the airline industry for a long time and airlines as a business, and then he decided to invest in them. So essentially he went against his own hypothesis and paid for it. They also sold a large portion of their US bank holdings. So they sold all of their holdings in JP Morgan. Bank of America, they bought more. And I believe Wells Fargo, they also bought some more as well. One of the big purchases they made, and the first purchase they made of the year, was Dominion Energy's natural gas assets. So they didn't buy the company, Dominion Energy. They just bought the gas pipelines, which they will incorporate into Berkshire's other natural gas businesses that they control. They also bought Barrick Gold, which made the headlines, and a lot of the headlines themselves were Buffett buys gold. And I mean, this is not strictly true. He didn't buy any physical gold. Barrick Gold is a large gold mining company, so it gives them exposure to gold, but it's not physical gold. It's still a company, still shares, still US dollars, but it just gives exposure to the gold industry, which we also advocated in both of our first two books with Sandstorm Gold, which is a gold streamer, not a miner. Another stock that's been performing very, very well this year. It's up about 80%. They also bought Japanese banks. Classic value play. Felt like US banks were overpriced. Felt like Japanese banks were underpriced. So they bought some more Japanese banks. I can't claim I'm an expert on the Japanese banking industry, so I will just leave it at that. The second largest holding for Gates is a company called Waste Management, which some of you may not be familiar with, but it actually narrowly missed out on being one of our 20 for 20. I was actually going to include it as a bonus as the 21st stock, but I decided against that. But it's a great company, and I was pleasantly surprised to see it being such a high proportion of Gates holdings. But it's another Buffett influence pick, and you know, waste management is a highly concentrated industry, and there's only really a few companies controlling the majority of the market, which is very beneficial because it's not like the airline industry where everyone is just duking it out constantly, and it's really a race to the bottom on a lot of the routes. Whereas waste management, it's a stable industry. It's an industry that's not going away anytime soon. There's a lot of regulation because there was a lot of organized crime involvement for many, many years. And hence there's a lot of regulation regarding who can operate on certain routes. And this regulation means there's high barriers to entry, which gives waste management a significant moat. And then even in an uncertain market environment, people aren't going to stop getting their trash picked up, which means there's going to be steady cash flow there. This is definitely a Buffett business, and you can see Buffett's influence on this portfolio here with, a company like Waste Management making up such a high percentage of the portfolio at around 10%. Next up, we have Canadian National Railway, another Buffett pick for sure. I mean, it's the only transcontinental railway in North America. Industry leading margins. It's a railway company. It's a boring business, but consistent returns. I know Buffett loves railways. They bought Burlington Northern a few years ago. Canadian National, another one. Yeah, not much more to say other than it's a boring business with consistent returns. just keeps the portfolio ticking over. Walmart, another one, which is one of our 20 for 20, obviously. Just a classic business with a durable competitive advantage. You're not going to beat Walmart in the low price game. And one thing I noted in the book was that Walmart's management are some of the best in the game. And that's just been proven in the COVID environment. Their shift to e-commerce, which, I mentioned in an email a few weeks ago, and just how well they've done in adapting to that environment with same-day curbside pickup. In a market where even Amazon Prime is taking a week to deliver in some areas, the fact that you can get Walmart same-day curbside pickup is a real game changer for a lot of people. And, that's why Q1 and Q2 earnings beat analyst estimates, and Walmart stock has been performing pretty well this year. So, yeah, another solid holding there, and one that, I can see people holding for the next couple of decades. One I was surprised to see was Caterpillar, the leading brand in the heavy machinery industry. Heavy machinery itself is it's a cyclical industry because it pretty much fluctuates with home building, which in itself is cyclical. And so the knock-on effects there, if home building is down, heavy machinery is down. So as I noted in bear market investing strategies, home building is likely going to be hit pretty hard in the next few years. Although I should say in the past 6 months, home building has actually been surprisingly strong. So it is the most COVID vulnerable part of his portfolio. There's not too many stocks with potential huge downside because of the knock-on effects of everything that's going on right now. But this is the one definitely with the most exposure. So, he may decrease his holdings going forward, or he may just keep it based on the fact that the rest of the portfolio is pretty recession-proof. Another business I wanted to spotlight because not a lot of people will know about it is a company called Ecolab. And once again, it's a very boring business. They make cleaning products. Very Buffett business. Those industries that never go out of style, those industries that are recession-proof. And in the last recession, the company actually grew earnings per share in 3 consecutive years when everyone else was hemorrhaging money. So just goes to show, it's a very strong business that can thrive even in a down market environment. And you see here more than 1 million customer locations, 170 countries. So there's no one point of failure in the business. Once you have that distribution around the world, you're not dependent on one market. And, we've seen this time and time again. Companies that are really, really strong in one market, but as soon as that market turns, they just lose everything. And that was one of the key principles we really talked about in our first book, was don't buy companies that have a single point of failure. And, Ecolab is the opposite of that. So a very strong business, recession-proof. And it's also a dividend aristocrat, which means that's 25 years of consecutive increases in dividend payments. I'm not too sure that Bill Gates is fussed about dividends, to be honest. But for those of you who are interested, it is a dividend aristocrat. The yield itself is pretty small. I believe it's just around 1%, but another solid business. And the last company I wanted to just spotlight individually is Schrödinger Inc., the one that Gates owns 11% of. And this is really the only, it's really the only high-tech play in his major holdings. New company, IPO'd at the beginning of the year. It's traded pretty flat since then. But it's a drug delivery software. So a pretty wide client base. So biopharma companies, government institutions, academics. One thing I always look at when it comes to software platforms is I don't look at total number of users, because a lot of the times these companies use a freemium business model in that they try and get as many free customers as possible and then hope that those free customers will turn into paying customers. But those free customers cost the company money because obviously there's server space, there's bandwidth, there's upkeep, because you still have to do customer service for those free customers. So what I like to look at is the number of customers who have a high annual revenue, and most of these software companies use 100,000 a year as the cutoff point. And so Schrödinger now have 131 customers who have an annual revenue of over $100,000, which is going up year on year, and that's what you want to see. For those of you who have followed us for a while, since we first recommended Zoom, and it's up about 250% now, this was the key metric that fueled that growth. And when I emailed last week about them jumping 40% in a day, this was the metric that did it, because they showed that all of those free users that joined in March and April, a lot of them on the company enterprise side moved into paying customers and moved into that annual revenue over 100,000 a year level. And that's what you want to see from a software company. Another key metric is the retention rate. So what percentage of the customers stay on year after year? And, 96%, very, very high. Good to see. So, a couple of other thoughts. It's a well-diversified portfolio. 40% in Berkshire Hathaway, but Berkshire Hathaway itself is very, very diversified. It owns that cross-section. It has everything from consumer staples to technology to finance to consumer discretionary. So it has that cross-section itself. And, you can almost look at Berkshire like a broad ETF because of just how many companies it owns or has a stake in different sectors. So that in itself isn't a concern. There is a little bit of overlap. One thing I thought was funny was that he owns Apple and also owns Berkshire Hathaway, which has a significant stake in Apple. And his holdings in Apple, because of Berkshire Hathaway's holdings, will actually be worth more than his individual stake, which makes his individual stake a little bit redundant. But that's just something to recognize. If you're buying a lot of companies in similar sectors, then you might just be better off buying a sector ETF than owning all these individual companies, because you're spending all this money, especially if you're not on a free commission platform, or you're buying small amounts where commissions add up. Then just think about it that way. So yeah, there's a little bit of overlap. I thought that owning both UPS and FedEx was slightly redundant to similar companies, although they both have performed well this year. FedEx is up about 50%, which out of all the stocks Gates owns, only Apple and Amazon were up higher. But I'm not sure if he captured all those gains because those tech holdings were added this year. Apple, Amazon, Google, Alibaba, and Twitter were all bought in the first quarter. So unless he bought them at the lows in March, he wouldn't have captured all of that upside. But overall, it's a very strong portfolio. It's what I would expect from someone who lets Buffett manage his money. And yeah, there's a lot to learn from here, especially with some of these very, very unsexy companies like the Waste Managements and the Ecolabs of the world. And you don't have to go 100% in tech, and I know that's what gets all the news. Especially the past few weeks with Apple and Tesla and the stock splits. But you can still make great returns, and you can still get some great diversification from companies which are always going to be there. They're not particularly affected by a recession, and they're not particularly affected by, you know, the changing demographic and working environment that this post-pandemic world is bringing. So I hope you all enjoyed this video. I hope you enjoyed this analysis. If you did and you want to see more of these, then just leave a comment down below, because I'm happy to do more. I love doing these videos. And yeah, thanks for watching.